Welcome to Growth Investing Mastery. This video will look at microcap stocks with a venture style. As a reminder, this is not investment advice or recommendations to buy any stocks. The purpose of this video is to expand our horizon on smaller companies in the stock market. We are using the same rigorous research process to find these companies, and our venture style will hold to the next earnings report. But our venture style will do less earnings prep before the earnings of these companies, and that allows us to focus on our top holdings still. We expect our microcap ventures to make up about 5 to 10% of our total portfolio. One real caution is that microcaps are often low volume with a weak market maker. Because of this, it makes sense to look at the bid-ask spread on these companies if you're interested. And if you're new to the channel, Growth Investing Mastery is a channel that's focused on getting superior returns. Our new microcap ventures include 3 new stocks, and the first is BioHarvest Sciences with symbol BHST at 3% of our total portfolio. Next, we have Organigram Global with symbol OGI at 2.7%. And lastly, we have CPS Technologies with symbol CPSH at 1%. These allocations correspond to my confidence in these companies. So BioHarvest Sciences is my most confident pick amongst these companies, and I'm a little less sure about CPS Technologies. These 3 companies make up 6.7% of our total portfolio. Let's now do an overview of BioHarvest Sciences with symbol BHST. Their product is plant-based exome production, and they have a botanical synthesis technology. BioHarvest is a Vancouver-based company that is dual-listed on the Toronto and NASDAQ exchanges. And this is a pretty rare scenario that comes up in the market sometimes, where management announces a scientific breakthrough. The company's management held a special call to detail the new invention or innovations. Right away, one quote stood out to me. They said, "We will change the world of health and wellness for hundreds of millions of people, whilst preserving the planet for generations to come." And usually when I hear such a bold statement with this overly grand language, it's a bit of a warning sign. So I was pretty skeptical right away until I started reading more from this special call and their last earnings report. This announcement got very little attention, and the market yawned at the announcement. There was practically no trading volume based off this announcement. To give some more details of their product, they have something called bioreactors, which create a compound that is an antioxidant, anti-inflammatory, anti-aging, and has antimicrobial properties. The company's Vinia brand is sold on Amazon, and they have teas, chews, and capsules. This part of the business has 90% gross margins. And the Vinia brand in the different form factors has similar nutritional benefits to eating 2,000 grapes without all the sugar. The underlying compound has vast applications in cosmetics, pharma, and nutrition. Additionally, BioHarvest is what's known as a CDMO, or they do contract manufacturing for other companies. Some big takeaways from the material I reviewed are that BioHarvest is already disrupting the supply chain as the replacement in the chain. The company is launching an electrolyte drink in October, and that could give the stock some positive momentum on that press release. BioHarvest has big plans to scale up, which is something we want to see with all our companies. Their bioreactors started at 300 liters, and they're currently at 1,200 liters, with plans to expand the bioreactors going up all the way to 2,000 liters. Let's now jump into the details of the invention that BioHarvest announced. The company is trying to explain the magnitude of the technology breakthrough and the revenue implications. The company's systems are now able to produce planted exomes. These are nano-sized extracellular verticals that are secreted by plant cells, and they can be leveraged for pharmaceutical-grade delivery systems, nutraceuticals, and importantly, breakthrough cosmetic formulations. The company says their BioHarvest bioreactors deliver superior yield, quality, and scalability. This new product opens very powerful new revenue streams for CDMO customers. Vinia fern is a natural compound. Its 120 nanometers allow for skin absorption. One quote that was relevant to the business is plant exomes today are one of the hottest subjects amongst cosmetic companies. The compound also gives cardiovascular health benefits and cognitive support. They say there's superior science, superior taste, superior efficacy, and it's all backed by clinical trial regimens. Their new drink is said to offer better blood flow, better hydration, and more oxygen flow to muscles. Lastly, they said life-changing compounds on plants at the cell level. My read on this is that these are extremely bold claims that they're able to produce an electrolyte drink that has all these health benefits. But I think this management team actually believes what they're saying, and they do believe they're going to change the world with this drink and this compound going into energy drinks, cosmetics, and pharmaceuticals. Taking a look at the numbers for BioHarvest, they had revenue of 8.5 million in the latest quarter, which was up 41% year over year. EBITDA came in at negative 1.4 million, and net income was negative 4.1 million. Gross margin was 60%, which was up 800 basis points from a year ago. Because the company is scaling up right now, it impacts profitability. So I'm not too concerned about seeing negative EBITDA and net income at this point when they're still growing. The company did say they expect Q4 adjusted EBITDA profitability. So it's a good sign when the company's on track to get to profitability. The Vinia direct-to-consumer product has sold $60 million worth of product since launching in 2021. BioHarvest is getting leverage from their technology. They've recently seen 22% larger bioreactors created, and that's with enhanced manufacturing yields. Additionally, there's continued digitization of biological production workflows. The sales on Amazon make up about 20% of revenue currently. General and administrative costs increased 61% year over year, but the company said this was from a one-time NASDAQ corporate compliance upgrade. Detailing more of the products they have, BioHarvest said the coffee and tea products are higher margin than the capsules. Management said they have a manufacturing optimization, and in a single month, they're using between 100 to 140 bioreactors. Here's one quote I liked. No other company in the world that handles the quantum scale of bioreactors that we handle. This is number one. Getting more into the narrative for BioHarvest, they have a botanical synthesis technology that's driving two major bets for the rest of the year. The first is their direct-to-consumer business, which is a validation of the technology to manufacture at scale. The CDMO side of the business is the second bet, and that's already had 3 significant contracts that are making progress. The company said they have a highly premium pipeline, and they are tasked by cosmetic companies to research plant exomes. They're disrupting the hydration category, which is a multi-billion-dollar opportunity. Management said we've been very successful so far in the coffee space. They also mentioned that 30% of the electrolyte drink market is powders, and that's a very accessible market for BioHarvest. They added, "We're accessing with our channels, packaging more than a billion of opportunity." One more quote was, "So it's a monster market for us to access with the right disruptive proposition." The company's products are Informed Sports certified, and that means they can provide them to the US military, NBA, NCAA, MLS, and other sports leagues. BioHarvest has partnership deals with gyms and sporting associations. They additionally have something called the Health Pro Affiliate System. Management mentioned their highly technical and variable sales force that can extend via to unique channels. Here's one last quote, which absolutely blew me away. They said, "We are limited with the announcements because those pharma companies or other biotech entities are very careful as they wanted to disrupt the existing supply chain, and which is, in some case, we are the replacement of this supply chain." I wrote on the slide here, "Wow," in all caps. So BioHarvest is disrupting the supply chain completely, but they don't want to make these huge announcements yet because it could disrupt even more. Let's now look at some more details of BioHarvest's story. They had one CDMO project that advanced to stage 2 for a pharma company that's developing a therapeutic drug. Management added they have a 100% technical success rate when compounds complete stage 1. And this sounds really crazy to me that they're actually building in their product to therapeutic drugs, and pharma companies are really interested in their products. On the e-commerce side, the company said the wellness e-commerce machine is proving highly scalable. They're able to launch new products inside e-commerce channels without additional spend to open to those markets. The company's chews are Informed Sports certified, meeting global anti-doping standards. The company has a younger audience looking for an edge in the sports field or in the workplace. They launched 2 new superfood tea SKUs, and these are in K-cups following the Q1 debut of tea that was in satchels. Speaking again on the CDMO side, the company said they're pleased to report our deal funnel is very healthy. They signed the first contract for a fragrance molecule, and AI capabilities that BioHarvest has helped to secure this contract. Speaking on this fragrance molecule, management said the compound is a highly valuable compound derived from an endangered plant species that sells for thousands of dollars per kilo. Additionally, the company is launching the Venia Blood Flow Hydration Solution in October, and that's only 1 month away now. They expect this drink to be a breakthrough in the market, and they plan to be a disruptor, offering better blood flow and hydration. A few more quotes they had. Botanical synthesis is no longer just a breakthrough technology. It's a commercial platform with expanding utility across multiple high-value verticals. They added, customers that are finding us are totally intrigued, overwhelmed by the technology, and then start to understand what it could actually do for their respective businesses. Overall, I'm incredibly impressed with the story that BioHarvest is telling. And hopefully they're not just hyping things and they can actually deliver some results for investors. Moving on to our second company, we have Organigram with symbol OGI. The company is the #1 licensed cannabis producer in Canada. They have 11.6% of the market share, and this is 2.5 points above the nearest competitor. In the latest quarter, the company posted $52 million of revenue, which was up 72% year over year, and that's 71 million measured in Canadian dollars. There is a heavy caveat here that 72% revenue growth comes mostly from an acquisition of a company called Motif, and Organigram itself has low organic growth. But it seems like Organigram got a great deal on acquiring Motif. Organigram currently has 86 million of cash on the balance sheet with negligible debt. Organigram's market cap is 240 million, so that 86 million of cash on the balance sheet makes up about 1/3 of the market cap. This latest quarter had EBITDA of 1.7 million and net income of minus 4.6 million. This is with gross margins of 37%. Adjusted EBITDA was 5.7 million versus 3.5 million a year ago. Looking back at the history of Organigram, the stock debuted in 2019 and got up to $30 a share, but now it's below $2 a share for a 95% loss. And we love to see a record revenue quarter with a stock price that's really depressed. That means we might be able to get good value here. Organigram is expanding internationally as markets open up overseas. Currently, 85% of sales are in Canada, but they're now exporting to 25 states in the US and to Germany, the UK, and Australia. There's improved efficiencies in the product, a record harvest, and increased expansions. Something important from the latest earnings call was the company lost some revenue this past quarter from an ERP system that had some failures. This was due to the merger with Motif, but the company says they fixed everything in June. However, the company made a big stink about how this impacted revenue in the current quarter. At first, I thought this may be a yellow or red flag that they can't get their systems together. However, now that everything's fixed, it's likely some of that revenue may pick up in this upcoming quarter. When we look at analyst estimates, they expect 53 million of revenue next quarter, which is about flat. And in Q4, they expect only 50 million in revenue. So analysts expect to see some sequential revenue declines coming up. And this is where we see our huge opportunity here. Our subjective take is that this company sounds like it's growing, and we'll detail those reasons on the next few slides. Let's now take a look at some numbers for Organigram. The overall Canadian recreational market is growing 7% year over year, and it's good to see the general market is growing, while Organigram is taking share within the market. They currently have 20.4% of the national vape segment in Canada and 8.3% of pre-rolls. The company harvested 24,000 kilograms from their Moncton facility, which is up 15% quarter over quarter, and it's a company record. So we really like to see numbers like something's up 15% quarter over quarter when analysts think the company will be flat on growth. Additionally, Organigram added over 14,000 kilograms of annual capacity. They also had an expansion of hydrocarbon extraction capacity, and this boosts hydrocarbon capacity by 87%. This saves on cost of goods sold by 2.7 million for key products, and that implies improved profitability for the company. International revenue was 7.4 million, which was up 208% year over year and 21% quarter over quarter. Again, we see this company is really scaling up on the international side. Cash flow from operations was 14.6 million versus negative 3.7 million a year ago. And that's great to see such a turnaround in the cash flows. One analyst noted in the question and answer session from the latest earnings, there looks to be a significant gross margin expansion in the next quarter. Management did confirm this is true, and they said there's synergies with the Motif acquisition, cost improvements, and capacity enhancement. Just one bit of caution here on numbers. Some numbers are reported in Canadian dollars, but a lot of data providers show US dollars. Additionally, the company discusses net versus gross revenues sometime, and it's important to keep in mind which one the company is talking about. But I looked into everything and it seems to check out with these numbers. Let's now dive into the Organigram narrative. There's a growing domestic market and meaningful international expansion. Shred remains one of the industry's top brands and one of the stickiest by repurchase rate. U.S. hemp derived cannabis beverages have seen explosive growth. Additionally, there's tailwinds for the beverage category as more provinces have favorable regulations. New Brunswick has signaled a desire to encourage category growth, and Manitoba supports the drink sector. The company operates 5 specialized facilities across Canada, and the company is looking to expand offerings to the higher margin premium segment. Their London distribution capex spend completes in the fall. That's a good sign for investors as well, as capex will go down, but capacity and distribution will increase. International revenue growth will be bolstered by pending EU GMP certification. The GMP there sounds for good manufacturing processes, and getting GMP removes the middleman in Portugal. And the company said German regulators are very careful about distribution. The company said, as a direct quote, "We expect both our domestic and international businesses to continue expanding in the coming quarters." And again, this is where the disconnect is with the analysts' estimates predicting flat or sequential declines. The company's saying something completely different, and they say they're growing. Management added international growth will have a margin enhancing effect, and that's also likely to benefit investors. Lastly, the company said they're investing $8 million in adding 9 new grow rooms. Overall, I see Organigram as an impressive company with significant growth prospects, while offering a compelling value at current prices. Getting into our third company, we have CPS Technologies with symbol CPSH. Their product is high-performance materials made from metal composites. And these products are used in transportation, energy, aviation, defense, and the electronics industries. It's described as an aluminum silicon carbide, or fiber reinforced aluminum. They also have ceramic composites. There's a proprietary technology called quickset injection molding, and that's for the delivery of the composites. The headquarters for CPS is in Massachusetts, and they did an IPO all the way back in 1987. The market cap is pretty tiny at 50 million, and they have 92 employees. Back in February of 2021, the stock reached $30 after closing a deal with the Navy. However, the Navy deal got canceled, and it was unrelated to anything CPS did, but the Navy changed its priorities. The stock went down significantly after that, and it's down about 90% since that $30 peak back in 2021. But when we look at the financial history, the company is at record revenue currently. This presents an opportunity for us as the company started growing again, but the market hasn't seemed to take any notice yet. Jumping into the numbers for CPS Technologies, the company had 8.1 million of revenue in the latest quarter, which was up 61% year over year. They had EBITDA of 0.3 million and net income of 0.1 million. Additionally, on their balance sheet, they have 3.4 million of cash and 0.1 million of debt. It's very rare to see a company this small have this good of profitability and strong revenue growth. The gross margin in the latest quarter was 16%, and gross profit was 1.3 million versus negative 0.2 million last year. A 16% gross margin is quite low, but the company has said there's initiatives that will have a positive impact on margins. And a lot of times we see lower margins when a company is building out a project. Once a project gets more mature, the margins usually go up as the company discovers additional efficiencies. Let's now expand on the narrative for CPS Technologies. They are focused on fulfilling strong demand for the remainder of this year and beyond, they said. There's improved ability to increase manufacturing output with a third production shift. Here's a couple direct quotes which explain the situation. We anticipate continued strong revenue results. That was followed by saying, manufacturing capacity has increased dramatically over the last several quarters in response to increased demand. So they're telling us point blank, they've increased manufacturing because they see increased demand. The company recently won its fourth SBIR contract with the Navy, and that's for an amphibious combat vehicle called an ACV. CPS also has SBIR contracts with the Army as well, so it's good to see it spread out amongst multiple divisions of the military. The company's proprietary AI Max metal composite has expanded interest across multiple large TAMs. So it seems like the products that CPS is developing might be applicable to a very wide range of different industries. The company has a pending patent for radiation shielding material, which is still under review. This patent originates from a Department of Energy program that initiated the research for CPS. The company said demand remains strong for core products, including metal matrix composites and hermetic packaging. They said there's newly added capability of a 5-axis machining. And I honestly have no idea what a 5-axis machining is, but it sounds good. They're making a lot of innovations and building out their products some more. The company added there's an opportunity in the data center with HVDC and base plates. HVDC stands for high voltage direct current, and it sounds like some of their materials may protect well against electrical issues that could happen in the data center. So I'm not too sure how big the opportunity is there in the data center, but that's pretty promising that they're talking about moving in that direction. Overall, CPS is a growing and profitable company, and it has a tiny market cap of just $50 million, which makes no sense to me. The narrative reads really strong for this company. Let's now summarize our findings. We've got 3 new exciting microcaps in our portfolio, and we're still maintaining our rigorous research process for these companies. We'll be holding to the next earnings report, but we won't be doing our typical earnings prep. This allows us to take opportunities in smaller companies without the added cognitive overload. By doing this, we can keep our focus still on our larger cap allocations. But we do want to allocate about 5 to 10% in these microcaps as long as the opportunities appear. And keeping in mind, a stock doing well in this portion of our portfolio may get moved up in allocation. We may also find additional microcaps that we'll add, and we'll detail those in monthly summaries. That concludes the video, and I'm definitely interested to hear your feedback if any of these companies look interesting to you, or if you have a favorite among the 3. As a final reminder, this is not investment advice or recommendations to buy any stocks. Thank you.